Have you ever wondered how a financial crisis unfolds? How it affects everyone, even those who are not directly involved? It's a chilling thought, isn't it? The mere idea that something so complex, so far-reaching could be set in motion by a series of seemingly unrelated events. Today we delve into the captivating tale of the European debt crisis, a story that begins with the financial crisis of 2007 to 2009. Imagine the world's economy as a house of cards, each card representing a different player, a different economy. Now, imagine a gust of wind, in the form of a financial crisis, sweeping through and unsettling the balance. That's what happened in the late 2000s. The world was shaken, and the eurozone was no exception. In the heart of the storm were the PIGS countries, Portugal, Ireland, Italy, Greece and Spain. These nations, grappling with their own economic challenges, were suddenly thrust into the limelight. They were in debt, and the debt was growing. A crisis was brewing, silently, unseen, like a ticking time bomb waiting for the right moment to explode. The PIGS countries, once a symbol of European unity and prosperity, were now a representation of a crisis about to unfold. Their economies, interwoven with the rest of the eurozone, were like threads in a tapestry. If one thread unraveled, the entire tapestry was at risk. And it was not just the eurozone that was in jeopardy. The ripples of this impending crisis would be felt across the Atlantic in the equity markets of the United States. You see, financial crises are not isolated events. They are a domino effect, a chain reaction that can topple economies and disrupt lives. That's the power, the magnitude of a crisis like the one that was looming over the eurozone. The stage was set, the players were in place. The financial crisis of 2007 to 2009 had created the perfect storm, the ideal conditions for a debt crisis to take root. The PIGS countries were at the epicenter, their mounting debt a ticking time bomb. But what really triggered the crisis? That's a question we'll explore in the next scene. Stay tuned. The crisis didn't just happen overnight, it was a series of events that led to the ultimate downfall. Picture a line of dominoes. Each one, a decision or an event that added to the growing momentum. The first domino was set into motion in 2007 when the US housing market bubble burst. This financial tsunami swept across the globe, affecting economies far and wide, and Europe was not spared. The next domino was the vulnerability of the PIGS countries, Portugal, Italy, Ireland, Greece and Spain. These nations were already grappling with high debt levels and fiscal deficits. The global financial crisis merely fanned the flames, pushing them closer to the precipice of default. Then came the domino that nobody saw coming, the banking system. Banks across the eurozone had invested heavily in sovereign bonds of the PIGS countries. As these nations teetered on the brink of default, the value of these bonds plummeted, leaving banks with enormous losses. But the dominoes didn't stop there. The crisis was further fueled by a lack of decisive action from European leaders. A combination of denial, delay, and half-hearted responses allowed the crisis to fester and grow, undermining confidence in the eurozone. The final domino was the contagion effect. The fear of a eurozone breakup led to panic selling of euro assets, pushing the value of the euro down. This had a knock-on effect on international markets, affecting equity markets from the Dow Jones to the Nasdaq. But here's the thing about dominoes. Once they start to fall, it's very hard to stop them. And that's exactly what happened in Europe. The crisis, which started as a localized problem in a few countries, spread across the entire eurozone, pulling in even the stronger economies into its vortex. And then, the crisis hit, sending shockwaves through the eurozone. The domino effect was in full swing, and the impact was catastrophic. But as we'll see in the next scene, the aftermath of the crisis was just as significant as the events leading up to it. Stay tuned. The impact of the crisis was felt far and wide, but how did it affect the markets and the economy? Let's delve into the aftermath of the European debt crisis. The ripple effects cascaded far beyond the PIGS countries, shaking the core of the eurozone, and indeed, the global financial landscape. First, let's talk about credit default swaps. These financial derivatives, essentially insurance policies against default, were suddenly in the spotlight. The cost of insuring against default skyrocketed, reflecting the heightened risk perceived in the market. This not only magnified the crisis, but also exposed the interconnectedness of global finance. Moving on to the euro, the shared currency of the eurozone. The crisis shook confidence in the euro, causing it to depreciate significantly against other major currencies. Countries outside the eurozone, who had conducted trade in euros, found themselves grappling with unexpected losses. The devaluation of the euro was a stark reminder of how economic tremors in one region can resonate globally. Now let's turn our attention to the equity markets. The crisis led to a sharp decline in the stock markets, not just in Europe but also in the United States. Major indices like the S&P 500, Dow Jones and Nasdaq all took a hit. Investors, gripped by fear, pulled out of equities, triggering a sell-off that further deepened the crisis. The aftermath of the crisis was not limited to these financial aspects. The social impact was equally profound. Unemployment rates soared, austerity measures were implemented, and economic growth stagnated. The crisis underlined the importance of economic resilience and prudent financial management. It served as a brutal reminder of the vulnerability of global finance and the domino effect one country's debt can have on the world. But here's a thought to ponder on. Could we have navigated this storm differently? Could we have traded the crisis in a way that would have shielded us from the worst of its impacts? But could this crisis have been traded differently? They say hindsight is 20/20. Let's examine how the crisis could have been traded and what could have been done to protect portfolios. As we turn the pages back to the European debt crisis, one name that stands out is Kyle Bass. Bass, an American hedge fund manager, made a fortune by betting against the subprime mortgage market and later capitalized on the European debt crisis. His strategy was simple, yet brilliant. He bought credit default swaps on Greek, Irish and Portuguese government debt, essentially betting that these countries would default on their loans. His gamble paid off handsomely when these nations indeed defaulted. Bass's strategy was not just about making profits, but also about protecting his investments. He understood the domino effect that a default in one country could have on the entire eurozone and prepared for it. This is an important lesson for investors, understanding the interconnectedness of markets and how a ripple in one can cause waves in others. But what about individual investors? How could they have structured their portfolios to weather the storm? In times of financial turmoil, diversification is key. A well-diversified portfolio would have included investments outside of the European markets, such as in emerging markets or safe havens like gold. It would also contain a mix of asset classes, including equities, bonds, and commodities. Moreover, investors could have used options to hedge their portfolios. Put options, for instance, would have allowed them to sell their assets at a predetermined price, thus limiting their losses. Similarly, they could have used call options to benefit from any potential upside. Another strategy would have been to invest in inverse exchange traded funds, ETFs. These funds are designed to increase in value when their underlying index decreases, offering a hedge against market downturns. Lastly, a portion of the portfolio could have been kept in cash or cash equivalents. This would have provided liquidity and a cushion against losses. So what can we learn from this crisis? The key takeaways are to understand market dynamics, diversify investments, use hedging instruments, and keep liquidity. These strategies not only protect your portfolio from downside risk, but also position you to take advantage of potential upside returns. Every crisis brings with it some valuable lessons. So what can we learn from the European debt crisis? As we delve into the core lessons, the first one is the importance of diversification. Spreading investments across various sectors and geographies can lessen the impact of a single market downturn. Secondly, understanding the market is key. The knowledge of the financial instruments you're investing in, such as credit default swaps, can be a game changer. Next, always be prepared for the unexpected. As the crisis showed us, even stable economies can falter. Hence, it's crucial to have a risk management strategy in place. This might involve setting stop losses or investing in safe haven assets like gold. Finally, remember that every crisis also presents opportunities. Astute investors often find undervalued assets during these times. For instance, Kyle Bass made a killing with his bets on credit default swaps. Remember, a crisis is not just a time of turmoil, but also an opportunity. The European debt crisis was a monumental event that reshaped the financial landscape. This financial tempest was born from the fallout of the 2007 to 2009 financial crisis, ultimately leading to a debt crisis in the eurozone, particularly in the PEIGS countries. The crisis had far-reaching effects, impacting credit default swaps, the euro currency, and equity markets not just in Europe, but also in the United States. In hindsight, trading during the crisis would have required a keen eye and a calculated approach, much like the one Kyle Bass utilized with credit default swaps. Structuring your portfolio to mitigate the risk of downside return, while still seeking potential upside return, would have been the ideal strategy. The key lesson here is to be prepared. Understanding these events and their impacts can provide a roadmap for navigating future crises, helping to safeguard your investments. So, are you ready to face the next crisis? Before we part ways, here's something you can do. If you found this video insightful, give it a thumbs up, leave your thoughts in the comments, and don't forget to hit that subscribe button. Share it with others who might benefit from this information. Remember, knowledge is power. Stay informed, stay ahead.